Everyone, good morning and welcome. I'm Joe Witt from the MBA, and I want to welcome you to this edition of the MBA Banking Buzz. My guest today is Tess Rice, MBA's General Counsel and Director of Government Relations. Welcome, Tess.
Thank you, Joe. Glad to be here.
Oh, it's just wonderful that you're here. Thank you to all the bankers for joining us today. We're going to talk today about a bunch of regulatory developments that have been going on in banking. We have been hearing a lot about the Trump administration's desire to roll back some of the banking regulations. In the last administration, a lot of people think the pendulum went a little bit too far. So the Trump administration is interested in swinging back more towards the center. We recently held our annual Banker Regulator Forum, and we heard a lot of interesting information from the regulators that were on that panel. One of the things we're hearing specifically is that the regulators want to begin tailoring regulations so that they fit community bankers better than they have in the past. We have been arguing for that concept for a lot of years, and every time that the regulators try to make a one-size-fits-all regulation, it never seems to fit community bankers. Last week, Fed Governor Mickey Bowman spearheaded a community bankers conference out in Washington, D.C. All of the speakers that day really embraced the idea of targeting and tailoring regulations so that they fit better for community banks. That's very exciting news. We're really pleased to hear it. Before we get started on our main subject for the day, I did want to give you an update on the MBA's lawsuit against the FDIC. In mid-September, the 8th Circuit Court of Appeals decided to affirm the lower court's decision to dismiss our lawsuit against the FDIC. The court made that decision because they said that the claims were not ripe. The claims that we made in our lawsuit were no longer ripe for adjudication, mainly because the FDIC is no longer enforcing that rule against the banks the way that they had been doing before we filed our lawsuit. Just a reminder about what the suit was about. It was about represented checks and whether banks could assess a second fee when they returned a represented check. The basic notion for the FDIC's lawsuit was that banks were charging more than one fee for what they were calling the same transaction. The FDIC created a very specific violation in the financial institution letter that they issued on this subject, and it was a deceptive UDAP claim. You remember that UDAP is unfair or deceptive acts and practices law. The deceptive part of UDAP is a situation where an organization fails to provide required information to consumers, and the failure to provide that information, the omission of that information, is considered material. The FDIC issued a financial institution that laid out the specific disclosures that banks needed to provide in order to avoid that violation. And that new required disclosure information was not already included in any of the banking laws and regulations. There's tens of thousands of pages of banking regulations, and these new disclosures that the FDIC created weren't in any of those existing regulations.
But at least they had the authority to do it, right, Joe?
Oh, yeah.
No, wait.
Actually, they don't, unfortunately. The second part of the fill is that it promised enforcement of these new rules that the FDIC put in place. The FDIC took an extremely aggressive position with respect to this particular issue. If you're an FDIC regulated bank, you remember that your examiners were calling on the phone, asking you where you were at with this. They cited tons of banks for violations, and they coerced a lot of other banks into taking corrective action on that rule, including restitution. So it was a very extreme enforcement position. So the goal of our lawsuit was to get the FDIC to stop enforcing that rule. In legal terms, our lawsuit was based on the fact that the FDIC issued a guidance document, but it was actually a legislative rule disguised as a guidance document. We took that position because it had the new requirements in it, and also because it had consequences. When we filed the lawsuit, I had two thoughts on how I thought we could win. The first one is I thought we could just win on the merits of our case. I thought the judges would agree with us that it was actually a regulation and not a guidance document. And we thought that we had them sort of coming and going. If it was a guidance document, they shouldn't have been able to cite banks for violating the rule. And if it was a rule, they didn't have authority to issue it. So I felt like we had them painted into a corner. I felt like we had them coming and going, as I said. The second way I thought we could win is I thought the FDIC might just want to settle the case. I think our lawyers did a great job of setting up our claims, and there was a thought in my head that maybe the FDIC would just settle. They didn't do that. Neither of those first two things came true. Something else did, though. After aggressively enforcing this rule for more than a year, after citing hundreds of banks for this violation, overnight, when we filed our lawsuit, the FDIC just completely stopped enforcing this rule. It went from driving 100 miles an hour to driving 0. Completely changed their enforcement position. Now, why did they do that? They did that because they had to. They needed to say that the financial institution letter was a guidance document only, and they needed to ensure that the guidance document did not have any consequences. So they traded their right to enforce the rule for dismissing the lawsuit. They basically lost by winning the lawsuit. And in a roundabout way, we won by losing the lawsuit. I did not see that coming, but it certainly worked. So what do we do next? Our next action is going to be, we're going to talk to the FDIC about convincing them, we're going to try to convince them to repeal the FIL as a guidance document. This guidance document is still on their books, and it has 3 major flaws in it that should cause the FDIC to want to get rid of it. Number 1, the whole premise of the rule is absolutely dead wrong legally. Their premise, again, was that you're charging more than one fee for the same transaction. That is legally false. The Uniform Commercial Code governs this. It's the law in all 50 states. A representment of a check that's been denied before is a separate item. It is not the same transaction. The FDIC should get rid of this guidance document for that reason. Second, the deceptive claim that's outlined in the guidance document that's still on their books is completely wrong as well. Again, the deceptive UDAP claim is when you're required to provide information and you fail to provide that information. The guidance document is wrong because if the FIL is just guidance, which is what the FDIC position is, there's nowhere in the law that these disclosures are required. Therefore, there can't be a deceptive claim because there's no requirement to provide the information. If it truly is a guidance document, the deceptive claim they created is completely wrong. And third, the guidance document includes inaccurate information about the FDIC's enforcement position. It still reads that they're going to aggressively enforce this rule, and they are not. For those 3 reasons, we think the FDIC should get rid of it, and I think we'll have a shot of talking. If I can get an audience with the director of the FDIC, Travis Hill, still acting director, I guess. Acting director for now, but he's been nominated as the director. I think we can get to him, and I think he would be interested in hearing what we have to say on this subject. We had a chance to meet with him in DC this year. He's a reasonable person. I really think we have a shot of getting that eliminated from the books. That would feel really, really good. I think this is a great example of the Biden administration's approach to consumer protection, where they not only protected consumers, they basically created a situation where consumers had no responsibility for their actions at all. There was no accountability built into the system. A check under the law is an order to pay. The consumer is ordering the bank to pay that check. Whether it's a first presentation of the check, first presentment of the check, or a second presentment of the check, it is an order for the bank to pay that item. The bank does all the same work. They have all the same legal obligations, whether it's a first presentment or a representment. The consumer should understand that if this is going to happen, there may be consequences. There were other situations where the Biden administration took a similar approach. Check processing order is another great example. The UCC, again, specifically states that a bank is allowed to process checks in any order that you want. There's two reasons for that. Number one, the consumer ordered the bank to make all those payments. And the consumer shouldn't be able to pick and choose which one should come first. Secondly, there's no way that's fair. If there isn't enough money in the account, something's going to happen negative for the consumer. But again, if you're operating in a world like the UCC where consumers have responsibility, it's something that they just have to accept, that if they write a bad check, there may be consequences. Same thing with that bogus authorized positive pay negative rule that they were enforcing for a while. That was based on the premise that some overdrafts or NSF situations may be inadvertent. Well, there's no such thing as inadvertent under the law. You either pay the check because there's money or you don't. If the consumer has responsibility, there's no such thing as inadvertent. And I think as we look at this next administration, they're going to take a very different approach. They aren't going to be looking at situations where consumers are just held completely harmless for all of their actions. And they aren't going to be blaming banks for actions that the consumer took. Again, I think we're going to see the pendulum swing back toward the center. This is not swinging in favor of the bank. It's just requiring the consumer to take some responsibility for some of their actions.
Yeah, so we see that right in the executive order from the White House in February. So not in office very long before they put out an executive order on deregulation, saying that the agencies have to, if they want to have a new rule, they need to get rid of 10 of them. So, and also that they should target rules that lack their congressional authority. So that's very important. That's what we're seeing now. The agencies are looking at what rules are based on, expectations are based on what Congress has said they're supposed to do, and what have they added through their own policies. And that's what the agencies are looking at, stripping away now.
And I mean, you get back to the basic civic lessons when you got the three branches of government. You've got the legislative branch that makes the laws. You got the executive branch that enforces the laws and writes interpreting regulations. And then you've got the judicial branch, which is going to settle any disputes. In the last administration, that middle prong, the middle prong of the executive branch, the regulatory agencies, was creating law rather than just implementing the law. So let's keep on the consumer compliance side. Tess, probably the agency that did the most egregious stuff in the last administration was the CFPB. Perfect examples where rather than just implementing the laws they were required to do, they were making it up as they went, adding new requirements. The 1071 rule is an obvious one where they took a 10-page statute and turned it into a 1,000-page regulation, added dozens and dozens of new requirements that weren't included in the law. So some of these rules that we focused on with the CFPB were not only challenging, they were illegal. So what did the new version of the CFPB do when they came into office?
So they put out their spring agenda and said that they have 24 items in there. And so one of the things they want to do is rewrite the rules on UDAP with 2 A's. Remember, the CFPB decided that if there was any discrimination claim that could fit under UDAP. So if you had a disparate impact on your customers, for example, they said that was inherently unfair under UDAP. So that took that out of that just being a disparate impact claim into an unfair and deceptive claim. And they did that just by adding it to their exam procedures. I mean, they didn't have a court telling them to do it or Congress telling them to do it. This is what they did. And so that's something they're pulling back. They said they're gonna clarify it, which is great. Well, it should be great. And narrow the scope and focus on clear consumer harm. So they're looking at really, was anyone hurt by this? Because they weren't doing that under the Biden administration. They just thought anything they thought was unfair was also harmful to consumers, right? So that would be a big change.
Yeah, and if you're gonna do that, you can't just update an exam manual. You have to go through the full rulemaking process. Again, you want to make sure that you have legal authority to do that.
Yeah.
But the proper way to enact a regulation that's binding is to go through the full rulemaking process, notice, comment period, act on the comments you receive both positively and negative, issue a final rule that has a forward-looking effective date.
Right.
That's how the process is supposed to work. Simply amending an exam procedure manual does not cut it.
No. And even if you follow the rules somewhat like they did with 1071, so they take maybe 13 lines you were supposed to track on business loans and change it in, I think, like 81 or something like that, right? But they didn't listen to the comments that they got.
Right.
And they didn't look at the impact on small businesses, and that they're required to do that. So there were a lot of flaws there too, hence all the lawsuits that came out of that.
Absolutely, and yeah, I mean, the process is supposed to ensure that it's fair. That's what the goal of the rules are. You follow administrative procedures to ensure fairness. And one of the claims you can make is that you act in an arbitrary and capricious manner. That instead of following the rules to the letter, and instead of, you basically go through the motions to arrive at the result you want, rather than truly following the procedures. And if you know, as long as that's one of the claims that we can make when we get harmed by that, you know, that should cause them to follow the rules and not just give it lip service. And hopefully we'll continue to see that going forward.
Yeah, so they'll reissue the 1071 rules, and I assume that they're gonna stick to what is required in the Dodd-Frank Act. There's also legislation in Congress to get rid of this part of the Dodd-Frank Act completely. But I do wonder, because they've cut their staff so much at the CFPB, like 90% of their staff is gone. So they have all these initiatives they want to achieve, but I wonder about the manpower available to do it.
Well, and so the original 1071 rule is either on hold or you know, it could be rescinded, right?
Mm-hmm.
So if this one takes a while, I don't think that hurts us.
No.
I think we'll accept that.
So I do feel badly for all the banks that put a lot of work into this already.
Oh, I know, exactly.
It's a shame in that sense.
Yeah. So the CFPB, you know, obviously they went back and looked backwards at some of the stuff was done and they corrected it. They fixed a lot of rules that we thought were suspect. They used a lot of guidance documents, and they said things like, this action that you take likely violates UDAP. It's a completely bogus approach. All those have been eliminated.
Right.
So we saw a lot of cleanup, but I think they've also taken a look at some of their more longstanding existing rules and made some changes to some of them. They are in charge of writing all of the consumer compliance regulations now. That was transferred from the Fed to them. So Regulation E and truth in lending, truth in savings. I think they've done some changes in some of those areas.
Yeah, they're looking at the remittance rules. They're gonna have new disclosures on those, try to clarify that. They're looking at the 1033 too. I suppose that's not total compliance, but the 1033 data sharing rule, they'll redo that. Also, they got rid of the medical reporting ban, you know, that used to be that, or their rule was that credit reporting agencies couldn't report medical debt. So they're repealing that one. There was a lawsuit on that one too. We have a state law like that was passed in, I think, 2024. And so it'll be kind of interesting to see if anything happens with that. Probably not.
Yeah. You know, one of the more interesting things that we heard from the FDIC on the compliance side of things during our banker regulator forum was a change to their compliance exam schedule.
Yeah.
That was some welcome news for banks that are doing a good job with compliance.
Mhm. Yeah, so the FDIC put out guidance. I think that one's the October 7th, information about what they're doing. And this is done. I mean, they could make this decision on their own, so it's done, but, so if a bank's under 350 million, they're supposed to go every 5 to 6 years with no midpoint exam. So your compliance exam would be stretched out as far as 5 or 6 years. I think that CRA at this point has to be every 4 years if you're satisfactory, so I don't know if they will go 5 to 6 or do the CRA alone. For the 350 million to 3 billion, that's every 4 to 5 years now with a midpoint risk assessment. So, and they're saying that risk assessment won't be like an exam. I mean, that would be the fear, but it would be, do you have new products? Have there been complaints? Things like that.
Yeah, exactly. They're not gonna do any testing there. They're not gonna do any review. They're looking for changes that they need to make in your risk assessment only. A new compliance officer might also fall under that thing if you got new people and you're trying to assess the risk of the organization in that midpoint thing. New products, new employees, all that sort of thing, new branches, new locations, changes to your assessment areas, all that stuff.
Yeah.
So that's welcome, very welcome news, that it's part of the overall tighter risk assessment. Where does the true risk lie?
Right.
If you are a community bank that's doing traditional banking services and you're doing a great job of serving your customers in your communities, you don't have complaints, they've figured out that they don't have to be there every 2 years.
Right, and really, what does this have to do with the safety and soundness of the bank, which is their most important function as well? We heard from the OCC person at the regulatory forum that OCC is not doing any fair lending exams at all. That was interesting. So unless risk justifies it, they won't do any kind of information collection at all. Flood insurance, they're not going to do any transaction testing. It's all gonna be risk-based. Yeah, so it really could streamline the exams that you do have.
Joe, we have a question from the audience.
Excellent.
Sandra would like to know, any idea when the FDIC exam schedule changes may take effect?
They've already taken effect, so that was something that they could do on their own, and it's already taken effect. So, I mean, and Dan Engen said that at the regulator forum as well. So I don't know when they communicated to their banks how your examinations schedules changed, but it's done.
It's a done deal.
Yeah.
Yeah, Sandra, if you need it, I'm looking over here. That's where Carly is, my bad. Sandra, if you need more information, go ahead and text legal@midbankers.com and we'll get you the site that you need.
Yeah.
One of the other tough regulations that we always struggle with compliance, and it seems like no matter how much you do, there continues to be risk. There are some changes announced to the BSA rules as well. I know there's a lot of reform they're looking at. They're looking at changing thresholds and are CTRs necessary, what do we do with all the SARs that are filed, et cetera. But there have been some initial steps on BSA.
Yeah, I think they're gonna look at trying to integrate it more with their safety and soundness exam, so it's not separate people coming in. And then they want to, there's some streamlining on they're gonna do clear procedures for due diligence on correspondent accounts and reduce prescriptive requirements for low risk scenarios. So hopefully they're gonna stop wasting their time on low risk things and look at material risks. That's what they're talking about. So high risk customers or transactions rather than exhaustive reviews is what they say.
One of the other things we talked about at the regulator panel was the debanking rule, executive order, excuse me. There was some information put out by the SBA. Banks had to look at their portfolios and make sure that they didn't do any debanking there. I think that's been simplified a little bit since the initial one for community banks, which is good. But one of the questions that came up with respect to that debanking thing was, is marijuana banking part of that debanking world?
Right.
And I think we heard pretty clearly that it's not in the eyes of the federal regulators, because the executive order applied to legal businesses. And under federal law, which is what they care about, marijuana is still illegal. So banking a marijuana business doesn't fall under that executive order for debanking, because it's not a legal business federally.
Right.
Did I say that correctly?
Yeah, I think that's what they said. And then the Department of Commerce chimed in. You know, they have a lot of experience now with marijuana banking. And they said, you know, for some banks, it doesn't make sense to do this. And they said it's hard to make money, right? With all the work that you have to do with the filing of the SARS and all that. I mean, it's a lot of work.
And that's a bit of a change. I think the state wanted to be super supportive of this. The Commerce Department is, you know, reports back up through the governor's office. And I think the word on the street early was, let's do what we can to support marijuana businesses through the state banking system. But I think there's additional challenges there that were maybe more significant than they recognized early. And I think this may be a slight change in the way that they look at it. There is still a way to do it. I think none of the regulators said definitively you can't do it, but they did say it adds a lot of risk, and you got to make sure that you account for all that risk. And I think the state is more in line with the federal regulators maybe than they were 6 months ago or a year ago.
Mm-hmm. That's what it felt like. Yeah.
Yeah. Okay, so we talked about some compliance stuff, BSA. There's also been a significant shift from the regulators into looking at true safety and soundness issues, the ones that really matter. So I know there's been a couple proclamations on that as well.
Yeah, so there was, of course, the reputation risk one. So you got to go through that one. But at the same time, they put out a proposal to define unsafe and unsound practices. This is the FDIC and the OCC, so they really are acting together, it appears, and that's the message we got at the regulator forum as well, is that they were in lockstep. I think the Fed would like to be together with them, but you know, the Fed sees themselves as more independent, and so they haven't been with them on these issuances.
Right. And you can see a little bit why the head of the OCC is on the FDIC board. And I think there has just been, I don't want to use political in the bad sense, but in the political sense, they are a little bit more lockstep, the OCC and the FDIC, because of that kind of cross-pollination there.
Yeah. So one of the things they want to do is establish a uniform definition of unsafe or unsound practice. So that would be interesting. And they want to limit it to actions that have caused or could reasonably be expected to cause material financial harm to the bank or significantly increase the risk of failure and costs to the deposit insurance fund. That's what they should do, right? I mean, that's what you need to focus on. And it comes back to Silicon Valley Bank and whether they were focusing on what they should have been focusing on, and clearly they weren't. Those are the things that matter. So we're going to look at material financial harm. And then another good thing in there is they want to change the memorandums requiring understanding, the issuing standards for that. They're going to focus on evidence-based material financial risks again. So rather than something wrong with your procedures or your documentation or non-financial issues like climate policies or governance policies, that's all out. This has to be evidence-based and material financial risk to the bank.
And the regulators talked about that at the panel. They are serious about that, and they love it, frankly. They found themselves being sort of forced to note these things that would require, the only way to require action was to note it in this way. And when there were all these ancillary issues floating around, they felt compelled to note it because they had to. It was the only way to document it properly, but that's out. That sort of documentation for the sake of it is out. They're getting back to true safety and soundness. Where does the risk lie? And I guess that's the message. You know, we're bumping up against our our time limit, but that's the message today
Mhm.
that we can deliver. A clear shift toward risk, true risk to the institution, true risk to the insurance fund, rather than some of the other things that they were focused on and in some cases just sort of made up.
Right. And really the idea I got from the forum is that they're excited about that. The examiners are excited about it, safety and soundness people at least, that's what they were trained to do.
Right.
And that's what makes sense. And so I think they are very willing to make these changes.
Excellent. Well, thank you again for joining us, Tess.
There you go.
Oh,
We have another question.
let's take another question from the audience.
Tim would like to know, do you think there are any chances HMDA filing requirements will be addressed by regulators?
I haven't heard anything, but it seems possible that they would look at the thresholds.
Yeah, so that was one where the thresholds were high.
Mhm.
The number of loans, the number of loans that kicked in reporting requirements was low. So more banks were covered.
Yeah.
They raised it.
Yeah.
So less banks were covered. Now, is there an opportunity to maybe reduce that, to reduce the number of filers? And I think that's maybe where we're talking about, that there's a strong chance.
Yeah, it fits within the administration's priorities and that deregulatory executive order. So I hope so.
I would think so too. I think it's right, given what we've heard, the low incidence of risk, that there's ever going to be anything wrong in those, in that HMDA data for the very small filers.
Right.
I think that fits right in the wheelhouse. So thanks for that question, Tim. We'd love to have that happen.
But also limited by the capability of the CFPB staff.
Again,
Things
yeah.
done, so.
They got a lot of stuff they want to do, and with the CFPB staff, the other thing, we always thought the best thing about the CFPB was the fact that they would regulate non-banks, and as their staffing was cut, their ability to regulate non-banks was reduced. That's a bad thing. We'd love to have them put a lot more emphasis on the non-banks rather than the banks, but yeah, so that challenges them even further when you start looking at their obligations to write rules, their obligations to regulate banks, and then also regulate the non-banks who have always had a very light touch. All right, well, thank you again, Tess, for joining me on this Banking Buzz.
Sure.
Bankers, thanks a lot for joining us today. We appreciate your support and have a great day.